Good evening, folks, and welcome to the Contrarian Trader. This is Robert Desmond. It is Sunday, November the 16th, 2007. Folks, I received a lot of emails last week from subscribers that aren't necessarily traders, but they do subscribe to the Contrarian Trader for my commentary and my view of the markets and where we're at in this current cycle, this current bear market cycle. It's been our contention that since November 2007, we have gone, the secular bear market has resumed its downtrend. We went bullish back in November of 2007. It's been a year, if you can believe that, a full year now of this selling. And we are up 20% on the year. And the fact that we were accurate in our call for the direction of the market over these past 12 months has kept a lot of people coming back and asking questions, because now we have some credibility as to where are we now in the cycle. And many of the people that subscribe to the Contrarian Trader aren't day traders or swing traders. These people are long-term traders, and they're looking for somebody that's going to give them a straight talk, and somebody that's going to be able to let them know on a technical basis and on an economic basis of whether or not it is time to start putting those long-term dollars back to work. Now, on Friday or Thursday, what we saw was a classic key reversal. It was an absolute thing of beauty. We rallied well off of our lows, closing up 500 points on high volume. Now, what that told me was that there were institutional managers out there willing to put some money back to work. Is this the end of the bear market as we know it? Absolutely not. But for the benefit of those who are looking to trade long term, I wanted to make this video especially for you. In my short term view, do I believe that we are ready to go into a short-term rally? Yes, I do. Long-term traders, stick with me on this, okay? I've asked many of the folks who have emailed me that are long-term traders who are in cash right now. What are you basing your thesis for going long-term now? And invariably, it comes down to the key reversal that we saw on Thursday. And what they're looking at is a daily chart. And back in November of 2007, when I made the call to go to cash and go short the market, it was not the daily charts that we were looking at. And when I make the call to let my folks know to go long on a long-term basis as investors, it will again be a return to the monthly charts. So this is a daily chart here, and it shows that we're setting up nicely for a short-term rally, so long as we put a stop loss right into this 818 level. Now, we have a great risk-to-reward ratio here. Would I have liked to have seen on Friday us rally and have a continuation of Thursday's run? Absolutely, yes. But let's consider Friday a gift. And that gift is that we had a pullback. And the volume, as you could see, did not swamp Thursday's very high volume. Granted, yes, I would like to have seen volume come a little bit lower, but you know what? It was average volume. It wasn't panic selling. And the way I could rationalize now that we had that sell-off is that a lot of traders did not want to go into the weekend long, because they were concerned about some sort of a commitment by the United States to the G20 summit that was being held in Washington over the weekend. Why they're having it with George W. Bush in office, I have no clue. This should have been held off until President-elect Obama got in, and then he could have made some sort of a policy statement. You know, this was just all showboating. That's all it was. Was there a reason to sell? No, not in my own opinion. Also, more than likely, what really precipitated the sell-off late in the afternoon was the redemptions by hedge funds. You have the window of time that these hedge funds could or investors in hedge funds can redeem their shares. That window is closing, if not closed now, effective Friday. So I think that's what precipitated the selling on Friday afternoon. We did see a rally come off the lows. The market went, at a quarter to 4, the market went green. At 4 o'clock is when it fell apart. So do I think that we have a short-term rally at hand here? Yes, I do. But for those investors who are looking to go invest for the long term, now is not the time to do it. I don't care that we saw a key reversal on Thursday. I don't care that the risk to reward that risk reward is very low. That if we break below 818, that we put a stop loss order in. You are not traders. You are not looking to play this market to trade. I don't want you to get discouraged. More than likely, if you invest now, you're not going to hold tight on your stop loss orders because you're investing in mutual funds, and it doesn't make sense for you at this point. So my suggestion to you is to hold off. Now, when do we want our investors to go long? For that, we want to go to the monthly chart. Okay? Now here's a resistance level that I drew this line back in, say, September of 2007 because I knew we were coming very, very close to the highs set back in March of 2000. Now, in October of 2007, we hit 1576, which is slightly above the 1553 mark, and I had so many emails that day when it hit 1576 that we were breaking out, and I had to try to calm everybody down and say, no, by no means are we out of the storm yet here. We need to see a continuation rally in November to confirm this uptrend. If not, keep your stop losses tight. We didn't go completely to cash by this point. Now, what had happened, what I pointed out to my investors is, look at this divergence here. Look at the market divergence. You had money flowing out as we were making new highs in the market. You had the relative strength index was declining. This is called a negative divergence. The market was weakening. All this was here were shorts that were being squeezed, and you had so much money being out there by hedge funds that they were leveraged to the hilt, and they were squeezing the shorts, trying to get every ounce out of this market before they knew it was going to crash. Housing was going to make it crash. The bad loans were going to make it crash. They knew it, and this was your setup. We had a double top. This is a super cycle double top, and more than likely, I'm willing to stake my reputation on it, that we are going to hit at some time in the future the lows set back in 2002 of 775. Now, if you're a long-term investor, that's the time when you want to start dollar cost averaging back in. Not a whole bunch, a little bit at a time. Because if we fail to hold 775, what's going to happen is we're going to break, and we're going to break fast, down to the 1996 lows of 600 on the S&P 500. It's going to get pretty ugly. So, folks, for those people that are anticipating going long, for the long term, wait until we hit 775 and we see a key reversal off that level. For those who are traders, start building your positions and anticipate a rally going up into the 1,000 level. If we break above this, you will probably see a rally going up into the 1,200 level, and more than likely we'll come back down and we'll break to new lows. As it stands right now, the government doesn't get it yet. They continue to spend like drunken sailors. The U.S. dollar is, you can see this negative divergence here as the dollar is rising. The RSI is weakening on the U.S. dollar. So be cautious, okay? We are by no means out of the woods yet. The macroeconomic picture is bleak in this country. Until we get spending under control, it is bleak. So please use caution. Folks, for those who would like to become members of the Contrarian Trader, please take advantage of a 14-day free trial offer. Please visit www.thecontrariantrader.com. thank you, and I appreciate your time, and I hope to see you soon more with new videos from the Contrarian Trader.